In the summer of 1929, a 23-year-old made his very first trade, betting the market would crash. Weeks later, it did. Everyone else lost everything. He doubled his money. And here's the part nobody tells you, that same man was still walking into his office and picking stocks, at 108 years old. His name was Irving Kahn. He learned directly from Benjamin Graham, the father of value investing. Today you'll learn the 3 habits that kept him rich and razor-sharp for nearly a century, and the third one is the one most investors get completely backwards. Picture it. 1929. The market is euphoric. Shoeshine boys are giving stock tips. And a young clerk named Irving Kahn does something strange. He borrows shares of a mining company called Magma Copper and sells them short. He was betting the price would fall. His colleagues thought he was crazy. Then October came. The crash wiped out nearly 90% of the market over the next 3 years. Fortunes vanished. But Kahn? He walked away with a profit on his very first move. So what did a 23-year-old know that the whole of Wall Street missed? Nothing about timing. Everything about value. Prices had detached from reality, and he simply refused to pay for hype. That single idea became the spine of his entire life. And it wasn't luck. Because right after that, he met the man who'd give the idea a name. Here's a number that should stop you. For roughly 80 years, Irving Kahn managed money using one framework, and he learned it from the source. In the early 1930s, Kahn became the teaching assistant to Benjamin Graham at Columbia University. Graham wrote the book on value investing, literally. Security Analysis. The Intelligent Investor. And sitting right beside him, grading papers and running the numbers, was Irving Kahn. Think about who else sat in those Columbia classrooms. A young Warren Buffett came through the same lineage. Kahn wasn't reading about the greats. He was one of them. In 1963, he became one of the very first people in the world to earn the CFA charter, the gold standard for analysts. But knowledge wasn't his edge. Plenty of people read Graham. Here's the question that actually matters: think about the last stock you bought. Did you buy the business, or did you buy the excitement? Be honest. That's the line that separated Kahn from almost everyone. And that brings us to the habit that kept him going for 109 years. Now here's what nobody tells you about living to 109 and staying rich. It wasn't a diet. It wasn't a secret. It was the exact opposite of what most investors do all day. Kahn barely traded. He'd hold positions for years, sometimes decades. He read constantly, thought slowly, and acted rarely. In an industry addicted to activity, his edge was stillness. He co-founded Kahn Brothers in 1978, at the age most people retire, 72, and grew it to manage around $1 billion. And the counterintuitive truth is this. The frantic investor, checking prices 10 times a day, feels productive. But that activity is usually destroying returns through fees, taxes, and emotional mistakes. The patient investor looks lazy. And the patient investor wins. Researchers at Albert Einstein College of Medicine actually studied Kahn and his siblings. All of them lived past 100. Same calm temperament. The scientists were hunting for a longevity gene. But there's a simpler lesson hiding in plain sight: a mind that doesn't panic protects both your health and your portfolio. So which camp are you in, the trader who acts every day, or the owner who waits? Tell me below. I already know which one Kahn would pick. At an age when most people can't remember what they had for breakfast, Irving Kahn was still going to work. He kept an office in Manhattan and analyzed companies well into his 108th year. He never chased the internet bubble in 2000. He never touched things he didn't understand. When people asked him about hot new tech stocks, he'd shrug. That was outside his circle. And that discipline is exactly why he was still standing when the fads collapsed. He worked not because he had to. He'd made his fortune long ago. He worked because the game itself, the patient hunt for value, never got old. And neither, it seemed, did he. Remember what I said at the start: his first trade was a bet against the crowd. His last trade, 80 years later, followed the exact same rule. Buy value. Ignore noise. Wait. Irving Kahn didn't beat the market with speed or genius. He beat it by refusing to play the game everyone else was playing. Slow, steady, and unshakably calm. That's the whole secret. There isn't a second one. So here's my question: could you hold a single stock for 10 years without touching it? Yes or no, tell me in the comments. And tomorrow, I'm breaking down the one balance sheet number that would have saved investors from every bubble in history.